Hey everyone, it's Imran from Options Insight, back with another macro options spotlight. Okay, so markets were pretty unchanged in the US as early strength faded ahead of Powell's testimony today in front of Congress. Probably won't get a whole lot out of him, but markets kind of wanting to know how he feels about the inflation fight that's going on right now and the repricing maybe that's the rates markets have done in the last few weeks. China stocks also sagged a bit. Trade data came out showing declines in imports and exports, and European stocks continue to be quite resilient relatively. Most commodities did pull back. Nat gas really getting hammered about 12%. That's usually, it swings around a lot after weekends as various data comes out. And it had a very strong rally last week of about 20%, back above $3, but that getting hit. And then oil and copper were actually firmer, eking out about 0.5% to 1% gains apiece. Looking at vols, US vols were pretty stable. So kind of grinding a little bit higher as some anticipation of movement later on in the week comes back. People may be starting to position for that, covering short vol positions, that sort of thing. Obviously, we've got non-farm payrolls on Friday and CPI next week. Europe and China vols did soften a bit. So you see a bit of red here. And then Japan vols caught a bit of a bid, and they were looking relatively cheap. For those of you who get our weekly, we had said that we thought Japanese vols were probably best value here, and they were starting to look quite low. Okay, in terms of commodity vols, the weaker commodities like the precious metals and nat gas did see a bid in vol, and then those two commodities that held up in terms of spot saw offers in their vol down about a vol point apiece. Looking at carry, we've got positive carry in the US indices, negative carry in Europe. It's quite unusual. Normally it's the other way around. We do think gamma selling should be concentrated on expiries that are before non-farm payrolls on Friday. We mentioned last week, 9th of March was our kind of preferred expression for an iron condor if you're going to play a range-bound market. Commodities carry picture unchanged. Precious metals and oil where the green is. That's where the short gamma is kind of working better. And the likes of nat gas and copper still moving around, making it difficult for gamma sellers. In terms of skew, we've seen quite a big offer come onto skew lately, continued yesterday. NASDAQ skew really the standout, down nearly a vol point, and that's on a single-digit percentile again. So we're seeing skew really get hammered, and that suggests to me that some upside demand's coming back now as NASDAQ has continued to charge on in the face of where rates are, which is quite interesting. And then we did see, I think Goldman's I've got price targets on Apple 30% higher, right? So, various things coming out to suggest there might be a chase coming on the upside at some point if equities can decouple from what rates are doing. And then in commodities, we saw a big bid come back to natural gas skew. Obviously on the break lower, 12% in a day is going to kind of spook markets a bit. And also copper skew starting to bounce as well. I had flipped over towards calls, but whilst we're testing $4 or getting close to $4 again, the skew to the downside starting to recover. Nothing too exciting to mention on the vol side, so let's move on to the charts. So big divergence really appearing between the MOVE index and the VIX index. So obviously the MOVE index has a strong impact on general risk asset performance, and rates volatility has typically led to more weakness in markets since 2022. So the latest spike in the MOVE, we did get a test down towards 3,900, but obviously we recovered since then, whereas the MOVE index has not really budged. So we had this big move up here, and the MOVE is still pretty much at local highs. So the MOVE is not really willing to relent until we get these big macro data prints out the way, like non-farms, like CPI, etc. Whereas if you look at the VIX is just completely rolled over and it hasn't waited. So this divergence between the MOVE and the VIX is quite interesting. My gut says to me that this won't persist. We're probably going to get some mean reversion. Maybe both of them are going to mean revert. So the VIX needs to bounce a bit and the MOVE needs to come down. But in theory, given the event risk that we've got over the next sort of week to 2 weeks, once that event risk passes, it's very likely that the MOVE needs to head lower to take some of that event risk out. So it might be that the VIX is kind of doing that ahead of time. And basically the VIX is doing that ahead of time, but the MOVE is kind of lagging a little bit because people are a bit more nervous about the potential rates volatility that can occur around these big old events. Okay. And then the last chart here is just Goldman's, where they kind of scan the whole cross section of positioning and sentiment indicators across various strategies and various assets. And they're seeing that sentiment is still more bearish than it was a month ago and 3 months ago, right? So from that perspective, they think there's some fuel for risk assets to perform, given where sentiment is, if these big data prints don't give us a shocker, basically, right? So clearly, we've had a big repricing in rates. If non-farms or CPI were to come in lower than expected, do we get a knee-jerk reaction in rates and some mean reversion? And does that fuel another leg higher in equities, right? That's kind of what we need to look out for, I think, right now at this juncture. Okay, looking at oil. So we mentioned oil briefly yesterday. Looking at oil a bit more closely, it is starting to show some signs that it may be getting close to an upside break. Okay, so if we look at the chart here, we've been consolidating for a while now, chopping around like this, but notice we're putting in slightly higher lows, and this topside resistance level is kind of in sight again, right? So a couple of percent away from this topside level. In USO, it kind of comes in at around 82 and a half. Okay, but we're talking about 2 to 3% higher than where we currently are. Now, if this level were to break, you potentially got some decent upside to come, right? Next big level would be around here, and then beyond that, who knows? Okay, so this is what we're thinking. Now, if we look at the volatility side of things, you know, vols are pretty much at the lows. Okay, so going back 3 months, but even if you go back a year and a half, vols are kind of at the lows here. And if we look at the upside, I mean, this level of vol that the upside is being priced at, I mean, is as low as any observation of vol we've seen for any level of spot in quite some time. So the idea being that the upside skew is not reflecting any risk that if we were to break higher, we would get an acceleration and we would get a load of volatility come back to the oil market, right? If it was reflecting that, you would expect more of a smile, and you expect these higher strikes to be trading at higher vols than where we currently are. And right now, that's just not the case. So we think there's some opportunity in maybe owning some of the upside in oil to reflect that there is no real upside tail being priced into the oil skew surface right now. Okay, so looking at the dashboard, so the skew is coming in at about 2 vols for put still. So it's fairly kind of mid-rangey. You know, in the extremes, when the war kicked off in Ukraine, it went to -20. So obviously oil upside just went crazy. But then in the extremes on the other way, it can be the same. Now, clearly, we are at the top Bollinger Band right now. We are testing upside levels. So spot is saying actually get bearish, don't get bullish. But me personally, I want to look at it more from a medium-term fundamental view, and I think oil could well break higher. So you know, you probably don't want to be piling into outright calls right now with too much delta on them, yeah, because you're basically buying the market at the local highs, which is tough to do. But looking at the vol, we see the vol here is at the lows of the range. Carry-wise, again, as well, carry's not great. It's positive carry, which means buying outright call options, again, is going to bleed probably. It's not doing that great. You're going to need a move to happen fairly sharpish. So you don't want too much of a theta bill. And then looking at the volatility side, the curve has collapsed into contango because of this low realized vol that we're seeing. So I'd probably prefer to park my long Vega positions in the medium part of the curve, which is still fairly low in the mid-30s. And we know it's got the potential to go into the 40s and 50s if you were to get that break higher. Okay, so looking at a term structure, that's what I'm thinking. So what's the structure that I would look at? All right, that's it for today. Thanks a lot as always, and I'll catch you tomorrow. Cheers.